All right. We want to make sure that we have time for all our good content, as well as plenty of time for Q&A. We know that there will be a lot of questions after this. This meeting, this webinar is recorded. In the next day or two, we'll send out a follow-up email to everyone who's registered. It will include a link to this recording so you can refer back to that. And anyone who's shown up late can catch up through there. So with that, I'm going to turn it over to Chelsea Hoy, who's going to be leading our presentation. We ask that everybody, as questions come up, please put them in the Q&A feature at the bottom, and we'll be monitoring that. Aside from some clarifying questions, we'll be answering most questions after we get through the initial presentation. So take it away.
Thank you, Mike. Well, good afternoon, everyone. As Mike said, my name is Chelsea Hoy. I serve as the Director of Government Affairs for the Iowa League of Cities. Joining me today, I have Alan Kemp, our Executive Director, and Mickey Shields, our Deputy Director and Director of Member Services. Thank you guys for joining me. Let me throw you in.
Glad to be here.
Good. All right, so it's been about a month since final adjournment of the legislature, and like many of you, we have spent the last several weeks digging through the details of Senate File 2472, which will be referred to many times throughout the presentation. This bill makes significant changes to Iowa's property tax system and will affect every community across the state in some way. Today's goal is not to cover every single provision of the bill. Rather, we want to help you guys understand what passed, what it means for cities, what implementation timelines look like moving forward, and where we still have some unanswered questions. I also want to acknowledge that many of you followed this process, this legislative session very closely, and I want to thank you for that, your engagement. While the leagues had some concerns with portions of the final bill, we do believe it's important to recognize where city advocacy was successful and where local officials helped to improve the final product. Most importantly today, we want you to leave today's webinar with a better understanding of what comes next and any, if any, actions your city should be considering right now. So we will continue on. Maybe. All right. So we put this presentation together, we really wanted to focus on what information would be the most helpful to city officials immediately following adjournment and signature of the bill by the governor. So today we're going to spend our time walking through the final version of the law that was signed on the 18th. Kicking off the first week of session, we had 3 robust property tax proposals to analyze. So there has been a lot of conversation about ideas and concepts and provisions, but ultimately not all of them were agreed to. So want to make sure that we're clearing up that confusion and you guys will walk away with a better understanding of what actually passed. We also will discuss timeline for implementation. While many provisions of the bill have become effective July 1, the practical impacts of cities will occur later in the budgeting process and through administrative guidance. We will also provide some initial guidance for consideration as cities begin thinking about implementation. And lastly here, we do want to talk a little bit about the league's advocacy efforts, member engagement throughout session, and some of the ways that city officials helped shape the final product. Before we get too far into the substance, I do think it's equally as important to talk about what we cannot answer today. The bill was signed a short time ago, just over 2 weeks. And so many implementation details are still being worked on by state agencies, namely the Department of Management, but also our friends at the county level, assessors, bond councils, many other stakeholders. So because of that, today's presentation is not intended to provide any legal advice, and it should not be interpreted as implementation guidance. That will come later. LSA is still working on the fiscal note. I'm hopeful that we see that maybe by this week's end. But there's just a lot that's still being considered. We're also not going to be providing city-specific tax projections. At this point, there are simply too many variables and too many unanswered questions to responsibly do that. And for you guys, any of you joining that have specific TIF questions, I would say that bond counsel will need
Presentation, isn't it?
Oh, I'm so sorry, guys. Give me a second.
Here you go. Trying to get the presentation. I'm sorry for the momentary pause.
Yeah, apologies, guys. Can you see my screen now, Mike?
Looks good, thanks.
Okay, thank you. So sorry about that, guys.
We thought we had it all figured out. Yeah.
We troubleshoot and everything. Okay, so you only missed a couple of slides just with our names. No worries there. All right, so back to things that we can't answer. We can't give you specific TIF answers. A lot of that is really going to depend on the specifics of your TIF district, ordinance, area. And so we do recommend that you consult with your bond counsel about any of those specific questions. But all that to say, we will, as we receive additional guidance from our friends and stakeholders, state agencies, we of course will be sharing more resources with our city members throughout the summer and fall. Okay, so just a couple of housekeeping notes. I have received word that there will be more presentations on this topic, go figure, in the coming months. So a couple that I know about that I just wanted to give you guys heads up on. The first one, the first couple by ISU Extension. So there's one coming up in a couple weeks, June 17th. So keep an eye out for communications about that. And then there will be another one in July, or another couple later on in the summer, likely in July, tentatively scheduled for the 7th, around property taxes in general, and then urban renewal and TIF specifically. That one will be in consultation with our friends at Allers and Cooney law firm, a lead partner. So keep an eye out for those. That'll be really good content information. Additionally, like Mike said, just a couple of housekeeping notes at the bottom about using the Q&A feature for any questions that you have as things come up. So one of the most common questions we've received since Sine Die has been, when does all of this actually take effect? The simple answer is July 1, but it's really much more complicated than that. So many provisions of Senate File 2472 become effective on July 1st, 2026, so about a month. However, the practical impacts of the bill will be spread out over multiple years through future assessment years and budget cycles. The first major milestone was May 18th. So like I said, just a couple weeks ago, when Governor Reynolds signed the bill into law. So there, as you look through the text of the bill, there are a number of references to the effective date. So for your awareness, the date that she signed it is the effective date that is referring to. So July 1st, most provisions do become effective. However, for many cities, this summer will primarily be focused on a period of learning, planning, and waiting for additional guidance from our state agencies and implementation partners. As we move into fiscal year 2027 and the next budget cycle, cities will begin evaluating the implications of revenue limitations, reserve fund requirements, taxpayer notice changes, and various other provisions throughout the bill. January 1, 2027 is another important date because several property tax and assessment provisions take effect at the beginning of the assessment year. Where'd it go? That includes the reestablishment of the multi-residential property classification, assessment appeal changes, and implementation of the new valuation framework. The city's 2% CGFL revenue limitation also begins applying to budgets and property taxes starting with fiscal year 2027 through fiscal year 30. We will then continue to see a phased-in implementation over the next several years. The school foundation levy buy-down occurs gradually and reaches the target rate in fiscal year 2029. The state backfill of the homestead credit is also phased out over a 3-year period beginning July 1, 2027.
Yeah, finish
Okay,
it.
okay.
When I'm doing that, you can do that. Sorry,
guys,
we're
technical
trying to make this perfect.
Let's see. School foundation levy buy down occurs gradually until it reaches its target date of $4.90 in fiscal year 2029. The state backfill of the homestead credit is also phased out over a 3-year period beginning July 1, 2027, ending July 1st, 2029. Finally, some of the most significant TIF-related provisions are long-term changes. Perpetual TIF limitations will not begin affecting increment until about 2 decades into the future, with the first major threshold occurring in 2046. So really looking ahead there. The key takeaway here that I would share is that while this legislation is now law, implementation is not happening all at once. Cities have time to understand these changes, and the league will continue to work with all of our partner organizations and the state lawmakers to provide guidance to you all as implementation moves forward.
Well, let's go ahead and
Okay.
while I'm talking, you can figure that out.
Okay.
All right.
All right, Mickey.
We apologize. We're trying to do this in the most sophisticated way possible, and that's turning out to bite us in the backside. But here we are. So the biggest question that our members tend to have when these big tax policy bills are adopted are, what do we do? And everyone gets super fired up and worried that they're going to have to make sudden changes, which is understandable, of course. But as Chelsea was just saying, the implementation of this bill is actually pretty stretched out in some cases. And in fact, it really will not impact the budget you all just adopted here recently for fiscal year 27, which begins July 1 of this year. And so in a broad sense, you're not going to have to do anything specific to your FY27 budget just because of this law change. Now, that being said, some of you veteran city officials on the webinar understand that even though that's the case, but because of the effective dates, that some of these future changes, you may want to work backwards to your FY27 budget and kind of get ahead of those. And that may cause you to do budget amendments at some point in the next fiscal year, once we get a better understanding of the impacts to your revenues, your expenditures, your urban renewal activities, and so on. So for right now, the guidance is be patient as much as you possibly can, but understand there's going to be some homework that we all need to do, again, as we get a better understanding of the bill and locally how this is going to impact your budgets. Now, that being said, cities have to do budget amendments all the time. That's very common. And so don't freak out that this may mean that you have to do a budget amendment at some point during the next fiscal year. There's a process to that. Many cities have to do budget amendments every fiscal year. Sometimes cities have to do multiple budget amendments. And so that alone is not a big issue, but there's a process to follow that some of you are quite familiar with, and you may have to do that. The other things that we would want you to say or understand right now, because again, it's kind of a hurry up and wait type of situation. As Chelsea said, we got to wait for some administrative rulemaking to be done, guidance from the Department of Management, and a quick nod to the invaluable Ted Nellison at the Department of Management, who works with us so well in city government land. And whenever these bills get passed, there's a whole bunch of work they have to do, technically speaking, to change their forms, change the process as the case may be. And Ted does just a wonderful job. And I know Carrie Johnson and others that work in the local government sphere with Department of Management have always done a great job of getting everything done and getting things ready. And so in some ways, we got to wait for them to do their jobs too, especially with the forms themselves. So that's another one that's, hurry, be patient as much as you possibly can. More guidance will certainly come out this summer and the fall. And then again, you veterans know typically in the wintertime is when the actual forms to use for the next budget cycle is when we get those out and so we can start using them. So there will be changes to the forms themselves, to the process itself. And we'll all kind of take that in and stay with us at the league. We'll have much more to come. The other one too here is with urban renewal, urban revitalization, TIF, tax abatement, whatever the case may be. Not every city uses those programs, of course, but some do both. There's going to be a lot of change coming to that, as Chelsea just alluded to. And the thing that we would definitely emphasize here is talk to your bond counsel, which again, most of you already do. You have regular meetings with those folks to discuss your activities, any changes you need to make. But the fall is a really crucial time with urban renewal and urban revitalization planning as it is. And so I would just lean into that, make sure that you are scheduling those meetings with your bond counsel and bond attorneys because you're going to want to make sure that your current plans are in good shape, but you also might have to make some adjustments because of what's going on within the bill as it relates to those kinds of programs and activities. So again, a lot of this is sort of be as patient as you can right now, and kind of do your homework, but then be ready for potential decisions to make and actions to make and stuff that you're going to put in front of your counsel, as we learn more.
Awesome. Thank you, Mickey.
And hopefully I bought us enough time to make the proper adjustments
I think we did.
All right. All right.
Spectacular.
Yeah.
All right, Alan, why don't you walk us through what kind of improvements did we get and who do we have to thank?
First of all, we knew that property taxes reform was going to be at the top of the legislatures and the governor's agenda. So that was no surprise. And honestly, to their credit, they filed bills early in the session so that we could begin to look at them and begin to develop an understanding. And they were very open to having conversations with us. It goes without saying, the league staff of Chelsea and Cody and Katie did a great job up at the Capitol, but they were really supplemented by others. First of all, we had the league's executive board and the legislative policy committee provided ongoing guidance throughout the lead up to the session and during the session. We also have our legislative champions. The idea here being that if we want every city in the state to have an individual that follows legislative issues and engages with us. Right now, we're up to, I think, 162. Is that what someone said?
Yeah, about 150.
About 150. Yeah. And we're continuing to grow that. And that's very helpful because the champions and other local elected officials, they were willing to come up with the Capitol if they were traveling to Des Moines, or more importantly, meet with legislators in their districts over the weekends at coffees. And that made a big difference. But I also think we did a really good job of coordinating with the Iowa City County Management Association, their public affairs committee that they've developed, the Iowa Municipal Finance Officers Association, and the group that they've put together to help us look at legislation. And finally, and I'll talk a little bit even more about this, and that's Piper Sandler. They did quite a bit of financial modeling. And all that work did secure some improvements from where the bills started. As I said, these bills, there was not a lot of agreement initially among the chambers and the governor. And so they had to do a lot of negotiation and gather a lot of information. One of the things that we were able to get accomplished, though, was that certainly there is a 2% cap, and we were not able to ensure an inflation adjustment to that, but we were able to get new construction to be able to come on to the city's assessments, so they get to recognize that growth. And there was also no cap on the debt service levy, and then also the special revenue levies. And these typically pay for items that are for a specific purpose and they're items that cities largely have no control over. So IPERS is set by the governors or by the state government. Property insurance, which we've seen significant increases, and so those were set outside of that limit. We were also, among other things, we were able to get the bill to include our updated taxpayer notice form. This is one that we worked in, we being the league, worked over the interim with other groups to sort of perfect. We wanted something that was clear, that was not only transparent, but was easily understood by the taxpayer. And so we think we've got that in a good position so that they understand where their taxes are going and if increases are occurring, what those actually are. To the benefit is that they also now require county auditors to provide parcel level reporting to Department of Management. That's going to be helpful to us long term in terms of modeling what our budgets may look like in the future. And then there was also some allowance for online posting of taxpayer notice forms. That's going to be helpful. Another thing we were able to get was on the bonding side was we could bond for direct and indirect capital expenditure still. They did limit to say that you cannot issue debt for ongoing general operations. But that's something that I think cities rarely utilize anyway. And so that was really not necessarily a concern if we're still able to utilize these for our capital and infrastructure expenditures. We're also quickly able to get them to understand our reserve limit. 10% was way too low. It's 35. And there was also then a recognition that you could create even an obligated funds account, which adds some transparency. My guess is cities were doing this anyway, either formally or even if informally. This will add some formality to it that you'll have to just identify exactly what an obligated fund account will look like. And we'll get that done over the interim, working with administrative agencies to come up with the rules for that. And then another one that we ended up was I think was very helpful, and that was the repeal of the low and moderate income for housing TIF. I know a lot of cities had ended up accumulating these funds over the years as required by state law, but there was sort of a challenge on how to effectively utilize them. And so what they did is they repealed that provision. We're still going to have to wait. I think Bond Council is considering what to do with cities that have accounts set up with low and moderate income. And so I think, we'll get information about that as we dig into the details of this. So I think, we ended up getting some really good outcomes from this. And I just want to really point out our partnership with Piper Sandler. So they were instrumental in working with us throughout the session. What they ended up doing is helping us do models. There were a number of models that were having to be created. It really helped city officials and the legislature understand when they were looking at particular provisions, what those provisions might look like in real time. That was a tremendous amount of work that they did. And they were very willing to jump in and do that with us. We've got these models now in place, and so we're wanting Piper Sandler to, and I know that they've agreed to do this, basically make that transition and now put in the actual final outcome of the bill and develop models so that cities can look forward and begin to assume what do our budgets look like under these provisions in 5 years. And so huge thanks to Piper Sandler for that work. So, Chelsea?
Yes, thank you, Alan. All right. And just a little bit of an update here. As Alan was continuing to discuss, Piper Sandler has been an incredible partner to us this session and beyond. But for some information, the Piper Sandler team is working on an updated model to share with league members. I'm hopeful that we can get that out to you guys this summer to help with budget projection so that you have a better idea of what the next few years look like. under this legislation. So stay tuned for that. I know we put out a number of models for members over the course of this session. And so we're not done yet, but it is, they're trying to make it even better for you guys. So just keep an eye out for more information there. Okay, so now we're going to get into the meat of the bill. This is what passed, essentially. And I do want to call out specifically that this will be focusing on the city provisions of the bill. It will not be all encompassing for other taxing entities. So be aware of that. Okay, so property tax revenue limitations. This is probably one of the most significant provisions affecting cities in the bill. So let's spend a minute walking through exactly what is and what's not capped. The headline provision is that the 2% revenue limitation. That was a consistent through line through all of the initial 3 proposals that were introduced at the beginning of session. As Alan iterated to, there was not necessarily a lot of consensus on what the reform package should look like, but the 2% cap was a very strong through line. And it wasn't necessarily a question of whether or not a 2% cap would be applied, but rather how that 2% revenue limitation would be applied. Ultimately, the cap is being applied to our consolidated general fund levy, so the CGFL, the levy where we really have the most control over our spending. Let's see. And this was a primary league advocacy effort for us throughout session. So I am very happy to be able to report that this is that we were successful in this endeavor. As was mentioned earlier as well, new valuation is also excluded from the cap. And the next slide will get into what exactly new valuation is, but think of it as new construction, essentially. So for the first year that a property comes onto the tax rolls, that new value, that new construction is not subject to the 2% revenue limitation. Also excluded from the cap are our special levies. And this, very similar to the first bullet point there, this was very important for us because these levies pay for very specific expenditures for city operations that ultimately are not within local control. This is something we spent a lot of time on explaining to lawmakers, as I know many of you did as well, helping them to understand that just like everyone out there, something like insurance is rising dramatically, and that is not something that we have control over. Additionally, I want to call out that debt service is also exempt from the 2% cap. Excuse me here. The other thing here that I want to call out is the 810 levy limit. So you guys all remember, of course, the 810 limit that was established under House File 718 a few years ago. That levy limit is maintained, and it has been extended. That deadline has been extended 2 years. So whereas previously all cities needed to come down and be below 810 or below in their consolidated general fund, now you have until fiscal year 2031. So a couple more years to meet that deadline. It's our understanding that there's about half of cities across the state that are still above 810. So have a couple more years to get that established, to get that down. But in fiscal year 30, this is where things change just a little bit. In fiscal year 30, your allowable revenue collection will be determined as the lesser of 2% growth, again, excluding new valuation, or the total assessment of property at that 810 limit. So whichever is less, that will be the restriction going forward in fiscal year 30 and beyond. So going back to new valuation, what is new value? So this is the definition as it's defined in the bill. But really, I mean, what you need to keep in mind here, new construction, major improvements, new valuation that's coming onto the tax rolls, annexations. Unfortunately, though, we did advocate very strongly for a more wholesome definition of new valuation to include both TIF release and abatement expirations. Ultimately, this is something that we were not able to get secured. And we've heard already from a number of members who have expressed disappointment on this provision specifically. So just know that we are continuing to have conversations with lawmakers and folks in the business communities about potentially, coming back and asking for some technical cleanup in this portion of the law to include the two bottom provisions. Okay, rollback and property classifications. There have been lots of discussions in the last couple of years about tinkering, making changes to the rollback system. Ultimately, those changes were really not agreed to. We had a lot of conversation about getting rid of the rollback entirely, but for the most part, that has been maintained. The big change in this area is the reestablishment of a separate multi-residential property classification. So for those of you who have been around local government for a while, this is essentially a return to a classification that existed previously before multi-residential property was consolidated into the residential classification. Under this bill, multi-residential property is defined as property consisting of 3 or more dwelling units. So single-family homes and duplexes remain classified as residential property. The legislation phases in a separate rollback treatment for multi-residential property over 3 years, beginning January 1st, 2027. Rather than focusing on the percentages themselves, I think the key takeaway for cities here is that this provision changes how certain housing types are treated within the property tax system. Apartment buildings and other qualifying multifamily housing will once again be treated differently, and ultimately will, once everything is phased in, kind of sit at a hovering 6% above the rollback rate for residential. We are still working through some of the implementation questions related to classifications and assessment administration. So I would encourage you to continue watching for guidance from assessors, Department of Management, and us as more information becomes available. For most of you out there, I don't think this is a provision that requires immediate action today, but something for you guys certainly to be aware of as you continue to think about tax-based composition within your communities. All right, homestead exemptions. So this is something that I expect city leaders will receive some questions from residents about going forward. We had a number of changes in the homestead area. So the residential property taxes, the space, the bill converts the homestead, what was a credit, into an exemption, which currently equates about $4,800, $5,000. So that state funding of the credit will be phased out over a 3-year time period, unfortunately. For years 1 and beyond, the exemption will be 10% with a minimum value of $5,500 up to a maximum exemption of $20,000. The exemption maximum will then rise with CPI, so Consumer Price Index, according to a cumulative adjustment factor moving forward. So the intention here by the legislature is really to keep folks' homestead exemption keeping pace with inflation. So the homeowner isn't losing that value. The bill also leaves in place current military and senior exemptions. I know there was a lot of conversation and frankly concern from our members about new senior exemptions being added to the system. Ultimately, that was not agreed to. The previous homestead credit funding will now be buying down the 540 levy to $4.90. There's an increase in the elderly and disabled rental credit from $1,000 to $1,500. The business property tax credit will remain, that threshold will remain at $1,500. There was conversation about increasing that by a couple $100,000. That was not agreed to, but the state backfill will be eliminated over time. And just a couple changes on the disabled veterans homestead benefit as well there. Okay, moving on to another favorite topic, TIF or tax increment financing. So there was a lot of conversation about TIF, frankly, the last couple of years, a lot of considered reform ideas. So here is what we landed on. Going forward, there will be a 23-year sunset on all future TIF projects. All of them. Doesn't matter what type of TIF we are looking at. And then a number of changes in the perpetual TIF space. So perpetual TIFs, and all of this section is effective January 1, 2027. So we do have a little bit of time to absorb these changes. So going forward for perpetuals, any generated income increments available for city use will be capped at 60% after 20 years. So to be clear, from year 1 until year 20, those perpetual TIFs will still be allowed to collect 100% of the increments. As I said, so in year 2046, which is wild to think about, 40% of that increment must be released to other taxing entities. And from our understanding, this might be pretty similar practice to what is going on right now, that folks potentially hold on to 60% of that increment. But that will be the rule going forward. Also in year 2046 and beyond, the 60% cap can be exceeded, but only to cover pre-existing bond obligations. And further, if a city keeps more than 60% of increment, the city cannot issue any new bonds for the TIF or capture any school foundation taxes while that threshold is exceeded. Finally, on this slide, the school foundation levy will no longer be available for perpetual TIFs after 20 years. So for further there, the state will be buying down the school foundation levy. This is a big part of the relief for residents, and that will be we sometimes call it the school foundation levy, the 540, but that will change, I suppose. It will be bought down to $4.90, and eliminated for use. The school foundation levy will be eliminated for use in perpetual TIFs after 20 years. Also regarding the school foundation levy, any future adopted TIF ordinances, so any new TIFs after January 1 of this next year, the school district that increment will no longer be automatically diverted from the school to the city. That is not something we automatically get to capture anymore. However, we were able to get inserted language that says a school district may opt in to either part or all of the school foundation levy for a TIF ordinance by passing a formal resolution to say so. So there is some optionality there that we were able to get secured. As Alan mentioned earlier, the LMI set-aside requirements have been repealed, essentially. And that is not to say that communities cannot put those money aside for LMI's projects. It's not a prohibition, but the requirements to do so is gone. So if your community has a lot of success with those kind of programs and putting those dollars to use, you are still allowed to do so. It will just be on your own volition. It will be something that you have to take on yourself. Right. Some bonding and general fund restrictions. So also something mentioned earlier, the bill does explicitly restrict the use of debt service for general operations funding, which I think we can all agree is a best practice. The idea being that you shouldn't be using one-time funds for ongoing expenses. That's a good rule. But we did have some concern about specific capital projects. So we were able to get language inserted. The league offered this that explicitly allows for both direct and indirect capital expenditures for large expenses or infrastructure projects. So we had a concern, especially like if a community is doing a big road project and they need to hire a contractor, an individual to do certain work. Those debt dollars can still be used to pay for their work, as that's not an ongoing operation. And this specifically does apply to fiscal years beginning on or after July 1st, 2027. So this is coming up. Unassigned general reserve funds within a city's budget will be limited to 35%. I think Alan is also the one that mentioned this earlier. The initial proposal here would have restricted us to reserve funds of 10%. And we offered feedback to lawmakers that would have been far too low and really would have had a significant outcome effect on our bond ratings. So ultimately that did get increased up to 35%, where I think it's a lot more comfortable. Also in this category, the bill requires cities to create an obligated funds account for funds that are specifically earmarked for either large equipment or infrastructure projects. So if you do have a reason to put these dollars aside, put them in this account, and those funds will not be subject to the 35% cap. So some good, really good work by membership across the state to secure a number of really good improvements to the language. Another achievement I would like to highlight, this was the league's #1 legislative priority for 2026. So I'm really happy to say that we got this secured. Since I began at the league, I think this is one of the first things that crossed my attention. A lot of city members bringing this up to me is that these mailers that go out to residents in March, this is something that was established, the requirement was established under House File 718, really as a transparency measure. And I think all the best intention in the world here, by lawmakers to help residents understand property taxes, which is a lofty goal. But the form itself, I believe, causes a lot of confusion. I think most people would agree with me. It is not specific to anyone's home. It offers speculative estimates. It's not helpful. So Mickey and Grace and our team here at the league last summer worked to revamp this mailer, and I'm very happy to be able to say that this is gonna go into law. So we will be continuing to work with the Department of Management to ensure that these notices are more accurate, easier to understand, and based on actual budget decisions rather than speculative estimates. Additionally, added into the legislation was a digital delivery option. So while this doesn't significantly impact city operations, just something that you can tell your friends at the county level, as I know that this comes at significant cost to the counties to mail them out physically. I think that is a added improvement to the legislation as well. All right, so some miscellaneous provisions just for your awareness, really. On assessments, the legislation shifts the burden of proof from the taxpayer to the assessor if the assessment increases are above 10%. So if a property is valued at 10% above of what it previously was, that burden is no longer on the taxpayer to prove that that's wrong. It's on the assessor to prove why that's correct. Also, this was a really big priority of Governor Reynolds, was establishing a first-time homebuyer program. So it's called the First Home Iowa Accounts Program, and will act very similarly to the 529 education savings accounts administered at the state level, and will be used. Homebuyers can use them for their first-time home purchases. So to get more young people into their homes. And then finally here, there are a couple of task forces that will be going on throughout the interim. Those reports, I think maybe the second report is due January 10th. I think the first one's maybe January 1st. But the one I'm a little more interested in is the payments in lieu of property taxes task force. So they're going to be bringing in folks from a swath of different areas, city, county, state agencies, and a lot of Polk County representatives as well. So Polk County, I think, has the highest number of property tax exempt properties that do receive services, fire, EMS, police, etc., but ultimately do not pay property taxes. So that will be an interesting one that we will certainly be watching and providing you guys with any information about those outcomes. Ultimately, any of those decisions will need to be made by the legislature once they adjourn, once they gavel in January. But it will be very interesting to see the report that comes out. All right. So some questions that we've noted and are still evaluating.
Right. So kind of reiterate that we are asking for all of your patience and all of your colleagues to continue to be patient as we all try to learn more. And some of the categories listed here are the things that we know already that we really need more input, particularly from our friends at the state government that are going to have a role to play in figuring out specifically how to handle some of these different things. Obviously, the taxpayer notice, as Chelsea talked about, that is going to be a work in progress. What does it mean for some of these different aspects of the law when it comes to the reserve funds? And there's a little carve out there as well. What does that exactly mean? How do we manage that as a city government when we do our budgets, especially next time around when we're talking about fiscal year 28? So many different classifications. What does that look like? And so there are some unanswered things right now that, we're just going to have to wait for more guidance. And as those answers are provided to us, we will certainly share those with the membership. And it will likely be something that's happening throughout summer and fall and leading into the budget season next winter. So we know these ones that we definitely need more information. That being said, I know we're also going to have a bunch of questions to answer here shortly that we'll get to in just a second. And so we'll do our best to answer what we can. The ones we can't, we'll be very honest with you all and say we don't know yet and do our best to get information out as we can get it.
Thanks, Vicki. Alan, you want to take us home?
Yeah, key takeaways. So, I mean, Senate File 2472 is now law. So we will move forward from here and work on implementation along the lines that Mickey just talked about. Again, most of these information details, I'll reiterate, would Mickey said, they're underdeveloped. So there's going to be a lot of questions that we have to answer yet. And so as they become clear, we'll share this information with the membership through all of our various mediums. I think cities do have time to prepare for major impacts. And having said that, I think they need to begin making preparations. I know that modeling is going to be critical moving forward. And of course, modeling is really based on, what your assumptions are. And so I think that'll be clear that we have to figure out what we think are viable assumptions to move forward. I don't think cities have been overreacting as they've put pauses on certain projects and on certain purchases. That's just good fiscal management. You don't want to obligate yourself to something that you may not be able to keep paying in the future. So I think that makes sense. That was not an overreaction. So I do again want to say that probably many of the people that are on this call had something to do with our advocacy efforts to get the final bill to an improved area and really help the legislature focus in on removing some of the more arduous and bad components of it that would have been sort of damaging to the state's economy, as cities are really the engines of economic development. So lawmakers are already beginning to ask the league, about some potential technical amendments. Not surprising. This is a complicated tax bill. Oftentimes, you think of things after the fact. And as those come up, we've got a growing list of things that we'll, want to bring to their attention. They've talked about a few of them. And so that'll certainly become a priority as we move towards the next session. And so, again, a little bit of patience, more guidance will be coming all this summer and through the fall. We'll make sure that we get you the information that you need as soon as it's available. So.
Thanks, Alan. All right. So we are going to move into the Q&A portion of the presentation. Mike, I'm going to call you back in and ask for your assistance in posing the questions.
Of course, thank you. Goodness, so we know that there is a lot here, and a lot that has happened recently. So, as you said, we're still digging in, but there are plenty of questions, of course, because it's a pretty wide-reaching bill. I want to start with one or two broad questions, and then we'll start to get into the nitty-gritty that's showing it in our Q&A. Thank you. People can still keep putting more questions in there. And I know that Cody and some of our other team members are also answering directly in the Q&A some of the more straightforward questions. So, Alan and Mickey, you guys have been with the league for a few years now. Can you talk about this property tax reform bill, this new legislation, sort of in context with past property tax reform? How does this compare with those changes?
I'll start out. I think the one thing that was in stark contrast is that we were engaged from the beginning, so that there really were no surprises. We knew that the legislature wanted to take this on. We knew that they had ideas. We were engaged with them early, so we were able to sort of guide the discussions as to items that would this could be very, very could represent a huge struggle. This might be able to be changed in a manner. I think that was a huge benefit, was that we were in there early on, and it wasn't something that was picked up late in the session and finalized. I think some people have looked at the last 30 hours, which was a marathon slugfest to get a property tax bill out. That was just a testament to the differences of opinion between the two chambers and the governor's office. And they just had to get to that point where difficult conversations had to be held to get to something coming out. And I think that's what you saw. And again, it's, when you do it that way, yeah, there's probably some unintended consequences that even they would recognize that may need to be adjusted. And so I think that was a big change that we had seen in the past. Like I said, I utilize this metaphor that we knew the ingredients that they were looking at. We just didn't know what the recipe would look like until the very end. And now that we've got the recipe, we can actually, cook it to see what we get out of it.
Mm-hmm.
Yeah, and I would just say from the historical context to answer that part of the question, this is a big change, without a doubt. They addressed elements of the property tax system that will make significant changes to how everything works. In some ways, it's tweaks, but other ways, we're doing new things, brand new things that have not been in the property tax system, which has largely been in place since the late 70s, and that's when the rollback was implemented. And of course, there's been some changes along the way. In my time at the league, I would say 2013 was a landmark year for property tax legislation, along with 2023. And I think this will go right there with those years where you're talking about wholesale changes. This is a 70, 80 page bill. So it's a pretty big deal, without a doubt. But to Alan's point, a lot of it wasn't surprising, and a lot of it we were able to shape in a way that was not as detrimental, I think it's fair to say. Maybe even some positive change in some other ways, particularly with the taxpayer notice forms, being better transparently as local government operators. I think that's a big upside. So there's things in there that I think we wanted, frankly, as a league, that we're able to get in there, and that's a credit to Chelsea and her team advocating on your behalf so well. So I don't want to belittle it. It's definitely a big change, and as we've been saying for the last hour or so, there's still a lot more to digest and understand. So it will cause all of our members to really get back into their budgets and figure out what the future looks like. And right now, again, we got a lot of question marks on what exactly that means locally, but it's here now. It is law, as Alan said. This is the law, and we are going to have to make our adjustments properly.
And I do think modeling is going to be that's going to be essential. At this point, if we were to look at the bill, we could all sit here and make assumptions. Well, it's going to do this and it's going to do that. We don't know until we do the modeling to figure out how it has impacts long term. And again, Iowa is a state of very, very divergent cities. And so they are all in a different state of growth, population. And so that's critical. I cannot say that all cities are going to see X. Instead, your city's outcome is going to be different from even a neighboring city. That's the reason we've continued to press. Modeling is going to be essential for each city to determine what their future looks like under this property tax change.
Correct.
Yeah. So we've already spent about an hour talking about this, and it didn't even cover everything. I know that our communications team will be working with Chelsea to help support this throughout, but early days, how can cities communicate this change to their citizens?
Download the League of Cities Communications Toolkit as step one. I mean, I'm only half kidding, but that is a great toolkit that our team and Mike and the rest of the communications team has put a lot of effort into, and I know some members are already utilizing that. There's a lot of things in that toolkit that any one of our members can utilize very effectively, very cheaply tomorrow. It's really that simple in some respects. But communication is the name of the game. I think it's fair to say we've somewhat kidded about this, but somewhat bemoaned the fact that a lot of residents and business owners don't quite get it. They don't quite understand how property taxes work. It is complicated. I think it's also fair to say that too many folks, in our view, too many folks take city services for granted. Everything is running smoothly. The streets get plowed, the water gets treated, the fires get put out. No problem, right? Well, behind all of that, of course, is a city government structure to make sure all those things are done and done as efficiently and as effectively as possible. This, in our eyes, is something that our members really need to step up. Not just property taxes, but all the things that you're doing. But because property taxes in large part support what you do on a daily basis. How do you communicate that though? That's up to you all. Every city is a little bit different on whether they have social media, websites, newsletters, town hall events, anything that you can think of though, I would say take advantage. If your city has a festival in the summertime, I would try to have your elected officials out there as probably they normally would be anyways, but be prepared to talk about this on a face-to-face, person-to-person level. Obviously, utilize what we put out to you all. We're going to be putting out all kinds of information through all of our normal channels. Take that, run with it. I would try to even host a special session here sometime soon with your public to give them the opportunity to learn more about all this. In some ways, your property owners in town, they're going to benefit from this. They might see a reduction in what they owe. So that's something you can be excited about in one respect, but also translate that to this could hamper, for some of our members, the ability to carry on and do things the same way they've been doing them in the past. That's also fair to put out there to your public. They need to know. But transparency is always the baseline.
I also think you need to, when you communicate, with your citizens, they need to recognize that property taxes really are an investment in the community. When you pay property taxes, those funds stay in the community. They don't go anywhere else. And you can actually point towards what property taxes paid for. You can point towards a fire station and fire equipment. You can point towards parks. You can point towards libraries, all the other things that a city does. And these are truly investments in the community. That was the whole purpose for this, is that you accumulate these funds for the benefit of the community. And so I think we've sort of lost that aspect, that this is truly an investment. And really, when you talk transparency, it's really about where do you want your investments made?
Mm-hmm. The only thing I would add on to that, Alan, is I think this could be a really good opportunity to do that education with your residents. Getting a captive audience to hear about property taxes is a difficult thing to do. I think we all know it's not the most exciting topic, but this is a natural lead-in to helping folks understand what the function is of property taxes. It's not necessarily a tax on your property. It is, but it pays for X, Y, Z, right? So as much as you can think of this as an opportunity, I would encourage you to do that.
All right. We are now going to jump deep in the weeds, start wading around there. Do you have a sense of how House File 718 is going to apply during fiscal year 28 and 29 versus what happens in fiscal year 30?
That's a really good question, and I don't know if we have a good sense of that just yet. There's two big factors here. We're still understanding this bill by itself, but House File 718 impacted cities differently. And one of the things that we know about our membership that we try to educate as many people as we can. Not every city is growing very quickly, whether that means population or property valuation, but some cities are, right? And so some cities were definitely hitting those different thresholds set up under House File 718 when it came to their valuation growth. And so that presented, and then I should also mention, from year to year, it's not the same. Cities can have wild swings depending on what's going on locally. And so that alone is a tough thing to say on a statewide basis. Here's what we're seeing. It's really not the case. with 937 cities out there in very different circumstances from town to town. Now, that being said, there is sort of a period of transition here in fiscal years 28 and 29 to kind of push all of the cities over to the new system, which I think was a fair component built into this piece of legislation, understanding that just quickly moving everybody from this House File 718 sort of ratcheting down system over to this new one would be pretty chaotic, frankly. So I think giving cities and local governments a couple of years to kind of transition, if you will, is thoughtful. But again, on a city to city basis, it's going to mean, well, it could mean things are quite different. And I would say that the biggest line in the sand there, with House File 17 in particular in mind, is the higher growth communities. You're kind of in one category, I would put you, and then the slower growth or no growth communities, you're in a different one. And so how that transition impacts it, I would probably look at it that way. Those are probably again, that line in the sand that I would be focused on.
Yeah. Ultimately, more details there to come.
Yeah, again, without applying each city's circumstances on your property valuation growth and your own tax rates, it's going to be hard for us to make a general statement. And so this is where Alan has stressed this, and we will continue to, with the modeling. The modeling done locally is going to be so critical to understand. So that's going to be something we'll be looking at as well. Our team will definitely be helping cities say, okay, if you're a high growth community, this is probably what I'd be trying to calculate. If you're a slower growth community, okay, this is what this could look like for you all. So that's what we'll be prepared to do. But again, each city is going to have to really look at their own data to figure out what this may mean for that transition period in fiscal years 28, 29, and then getting to 30, 31 and beyond. I know that's a non-answer. I apologize, folks, but it's so hard to make a general statement on property taxes in general. You guys have all heard me say this at the budget workshops for years. We just have so much difference from town to town that it's really difficult to ever make a big generalization.
Chelsea, I know it's early in the interim and there are elections coming up, so things are certainly subject to change. How receptive do you think the legislators will be to remove the TIF releases and abatement expirations from the 2% cap?
Yeah, great question. As I mentioned earlier, this is something that we advocated strongly for during legislative session. And at one point in that final weekend, there was a lot of ups and downs, but all to say, we thought at one point we had it. We had a lot of really positive conversations with lawmakers, helping them to understand the importance of getting TIF and abatement releases into that definition. And following the closure of session where we didn't secure it, we've already heard from lawmakers who have reached out to say that is something that they would like to go back and address. So there is a long time before, now in January, of course, but we already have interest, some buy-in. I do think over the next coming months, as cities look at their programs, potentially make pauses, I think that's going to possibly encourage other stakeholders to get involved in this discussion as well. That's certainly something I will be paying attention to. So I think it's likely going to be a topic an issue that we bring up next session for cleanup, and I don't think it is out of the realm of possibility as something we get accomplished next session. So I can make no promises.
I want to guarantee right now.
I wish. Yeah. But any of this, but all the documentation data that we can collect and between now and January, which is something the league will be focused on, getting that from you guys at the local level, that would be all the more of assistance come January when we go to make our case for why that's a change that's worthwhile.
So with the new taxpayer notice forms, how will that be handled electronically? Will they be posted to government websites? Do we know how that will work yet?
So that's going to be probably that's going to be a county by county determination. Ultimately, the county will need to decide if they even want to have electronic notification. The legislation does allow for it, but it does not require it. So ultimately, their residents of a particular county may not want that change. And so the county supervisors won't make it. But if they do allow to do that, it will probably depend again on the county for how those rules go into effect. It could be some kind of portal that they create for individuals to log into, or just, and that's the offshoot of their website. There'd be a lot of IT questions at the county level. Certainly something that we'll be in communication with ISAC about over the interim as well, as this conversation with Department of Management, who ultimately creates the template form to then give to counties as that whole process rolls out. So another non-answer for you.
Yeah, I just wanted to say we appreciate our partners at the county because this is a big responsibility for them, and it has been in recent years with the system that was developed. They have a lot of pressure to get these notices out, and now this is going to be a change. Now, it might make things a little bit easier, and hopefully a lot of counties are able to do this and kind of streamline things. But just like us in cities, not every county is the same. And so they have different resources, different capabilities, different staffing levels, you name it. And so we're just going to really support them and try to stay on their good side because this is the big responsibility they have.
Yeah, the league and the Iowa State Association of Counties and the Iowa State School Boards, probably the last year, we've been meeting very frequently. In fact, the directors of those organizations, we meet about twice a month to go over. So we've got a lot of good communication. We have a number of items sort of on our to-do list to discuss. I mean, this is clearly one of them, but that's just one of very many that we're working through because we've discovered it works. It's much better if we're working together and communicating one-on-one like that directly than it does through other means. And so we'll figure this out. Again, some of this is going to be Department of Management guidance. Once we get at that, counties can then move forward. We can certainly give our impressions of what we think would be the most effective approach. And so that, this bill is 30 days old. So there's an awful lot of work that we have to put into this yet.
Right.
Speaking to that, are there other things, other cleanup items beyond TIF and abatement into new construction that we're thinking about that might be on the table for next session?
Those are the specifics that have really emerged, like Alan said, within the last month. But that's certainly something that it's a great question because I would love that feedback from members, frankly, as we are going through figuring out implementation. That's when we're going to identify more of the sticking points, potentially areas where logistically something isn't working the way it's written. So we may need to go back and work through that. The only other thing that immediately jumps to mind is with the repeal of the LMI set aside requirements. Speaking with bond counsel last week, there were special rules around those dollars, and this is getting into the weeds, and bond counsel should be here to clarify this for me. But essentially, those dollars could be spent anywhere within the city limits, not just the TIF or area itself. And so that's a little bit in question now as to if the city opts to still collect those LMI dollars, because again, that is not a prohibition. Do they still have the allowances that the previous law provided? So that's one thing that I know was part of our discussion last week. But all to say, I think we're certainly going to be seeking that feedback from everybody over the next few months.
Yeah, I'd add in, keep your eye out for a membership survey that we'll be putting out there as a great way to let us know some of these priorities. But we're always here, we're always available. That you can reach out directly. We have a couple of different questions here about the obligated funds account. Can you provide any clarification about how that will be defined, if that will include city utilities, all that great stuff?
No, but that's the short answer.
Yeah.
I think this is going to have to be, I mean, part of this will have to go through the rules process of Department of Management to determine what that looks like. If I think if a plain reading would be if this is just restricted to general fund, then that's the general fund. The special revenue funds are different. And so that service fund is different. Your enterprise funds are different. They're calculate, they're tracked differently in the budget and in the annual financial report. So a plain reading would lead you to believe, all right, the 35% just applies to the city's general fund. But we'll have to determine exactly what that looks like. And that's going to come down to conversations with, the Department of Management as they review the bill and try to make a determination. So I know our position will be to make it as flexible as possible. That if it is a restriction, that restriction is clearly tied to sort of the narrowest of the general fund interpretation, but we'll just have to see.
Yeah, the only thing I'd add there is I know some cities, and I think it's very smart budgeting, is to set aside for capital projects. And then even in some cities, it gets even more broken out for different departments or program areas, if you want to use budget language, because they want to make sure that they're always putting aside some funds for future capital projects or purchases. So a new fire truck, a new fire station, a major road construction, those types of large scale projects that are going to happen at some point in the future. Every city has to make those investments at some point in time. No, there's no infrastructure on earth that lasts forever, unfortunately. And so it's very smart and frugal to put aside, when you can, any kind of surplus funds you have to basically buy down that future commitment that is going to, again, be quite substantial. Because if you don't, that just means typically more debt you're going to have to incur as a city to pay for that necessary expense. So in my mind, when I see this kind of language, that's what I think what we're getting at is basically a capital reserve fund, even though it's called obligated funds. But as Alan said, we're going to have to give more specific guidance or even definitions to make sure that is the case. But it does say general fund in the bill itself. So that I think that's one parameter that's already in place there. On the other hand, and I'm looking at the bill right here, it does get into different examples, but also just says vertical infrastructure and horizontal infrastructure. So public improvement projects of really any type would seemingly be eligible within this definition. So more to come, but this is one that I think hopefully does allow us for our members to continue to have some flexibility to make those investments for future needs, because that is smart budgeting.
Is there a list of every special levy that is excluded from the cap?
We have not created such, but that's something we can certainly include in some publication, whether it's the upcoming special report on the property tax law that we are working on. That's something we can absolutely provide to you. Yep. Make a note for that.
All right. For bonding, A city asked, we've bonded for minor equipment and vehicles and also bonded for demolition funds. Are these allowed moving forward?
I don't see why not. Now, this is every time anything related to urban renewal bonding, we're definitely going to say talk to your bond attorneys. We're going to continue to talk to our bond attorneys. My my understanding of all this is that that would not impact those types of activities because I think they would still qualify under the language that was adopted here related to the bonding, and so I think we feel pretty good about that. But again, this I know we're being recorded, so I got to be very careful right now to say that's another one we got to definitely be sure of in consultation with our bond attorney friends.
Yeah, that's right. Not knowing the specifics, I would say that there is nothing that I'm aware of in here that would prevent that from
Just
being
specifically,
yeah, there's no explicit
remove that
prohibition
as an allowed use
for demolition purposes. Yeah.
I need to ask a quick clarifying question. I think we covered it, but it seems very important, so I just want to make sure. What all is included under the 2% cap?
Sorry, say that again, Mike.
Yeah, say it again. I'm sorry.
What all is included under the 2% cap? What is that? What does the 2% cap apply to?
Apply to. It applies to the CGFL, so the Consolidated General Fund levy, your primary levy that cities use. That is where the 2% is applied.
Right.
How else would you say that differently?
Yeah. So at the start of the presentation, Chelsea went through that because this is probably like arguably the biggest element of this property tax legislation because it applies to everybody. Other elements don't apply to everybody. So, this is another one we're going to, before we put anything to print, we will definitely make sure we have this right. Mm-hmm. But the other levies, the special revenue levies in particular, are the ones who are outside of that CGFL. So this is a one where it does connect back to House File 718. If some of you are around a few years ago when House File 718 was adopted, this was a big element within that legislation where we went from having, I don't know, maybe 20-ish different levies available to city governments. Some of those were purely a council choice. Some of those required voter approval. A whole swath of those got eliminated, right? That limited our menu, shrunk our menu down quite a bit. And that's where that combined general fund or consolidated general fund levy term came from, basically taking those other levies and kind of squishing them in to the old 810. The other ones, though, that were outside of that, the most common ones that we see get utilized include levies for employee benefits, tort liability, property casualty insurance, and debt service. Those are probably the ones that are most commonly used by cities and have for years. So those would be outside of that CGFL. Again, we need to verify all of this to be very sure before we go to print. But I think we're pretty confident that that is what this bill is after when it comes to that 2% cap on what is capped and what is not.
Okay.
So, a question about the homestead exemption. Do we know when that will be applied to a home? Is it before the rollback or after the rollback?
Okay, so Cody and I have been trying to figure this out for a little while because this is important when it comes to the calculations.
Yeah.
We need this, it would sound like a broken record here, but we need to verify this, particularly with our county treasurers out there. And if there's any county treasurers on the webinar or county folks that know this really well, please chime in and share your expertise. I believe it's after your rollback has been applied is when they do their calculations to figure out for each property owner what they actually owe. So you got the rollback does the formula, right, for our reductions in taxable values. You got your assessed value, you got your taxable value. Taxable value is lower because of the rollback, right? So that's the first part of the system. Then you apply what used to be credits, which are really now exemptions, which is another big sea change from House File 718. But those are applied on a per parcel basis because not everybody receives the same exemptions. Some people don't get any. Some people get 2 or 3 if they're eligible for them, right? And I should say some properties, not necessarily people. And And so I believe it's all after the fact is when those credits / exemptions are calculated on a per parcel basis.
Yeah. The other thing I'll just jump in, take it a little bit of a different direction, but on the homestead exemption, that is only for someone's primary residence.
Correct.
You have to be living on the property. If you have more than one home, you only receive the homestead exemption for your one primary residence. So even though their other homes will be classified as residential, they'll get that taxable rate. They do not receive that additional exemption on top of it, only the once.
So, real quick, I want to say I really appreciate everyone being here, asking all these questions. We know more questions will come up. Please do reach out to us directly, especially to legislative staff at iowaleague.org. That'll reach Chelsea and her team, and they can answer. Alan, Mickey, the rest of our team is here to support as well. For the three of you, do you have any final thoughts as we wrap up?
Stay tuned. More information to come.
Yep. Yeah, I want to thank everyone for their engagement throughout the entirety of session. Seriously, huge. We will be here. We will continue to be here moving forward. So I know there's a lot of fear associated with change. I have that as well. But we are here to support you. So like Mike said, please just continue to be in contact with us.
Yeah, I just want to speak to the team effort from the league, internally, but also externally. It was very heartwarming this session to see so much support and so much engagement. These types of sessions and pieces of legislation can be a little bit divisive for our membership, and they have been in the past, and for a good reason, because again, these things impact cities differently, and then you're going to have some quote unquote winners and losers at times. But I felt in this session in particular that we really stayed together as an association, and that's what it takes to be successful. And so I wanted to thank everybody and thank our team for really being leaders in that respect and staying together. And that's what it takes. So thank you.
I'd just like to add, I will be sending out a follow-up to this tomorrow. It will include a link to the recording. It will include the slides. We saw that more than 300 of you registered for this. So if you do not hear from me by the end of the day tomorrow, please check your spam or reach out to me when I send to that many people. It's possible that things will get lost. And we want to make sure you all have this information. So if you don't hear from us in a day or two, please do reach out. We're here for you.
All right.
Thanks.
Thank you,
Mike.
guys. Thanks, Mike.
With that, thank you, everyone. Enjoy the rest of your day.
Thank you. Take care. Go vote.